We're not risk takers when it comes to the money we've saved, and you see people who are still have kept their 401ks, and they're losing money with the market the way it is, and you don't want to take that chance on losing it.
Last year, Tom and Kathy Izzo were faced with retiring during a downturn in the market.
Shortly after I retired, I think the Dow had gone up as high as 14,000, and I mean, I just knew that couldn't continue that way, and of course it wasn't long after that it started on its downward spiral.
To hedge against a bear market, the Izzos turned their 401k into an annuity that guarantees their principal remains intact.
I have an annuity that's called a fixed indexed annuity. Basically, you put a lump sum of money into this annuity, and you pick an option of some investment option. I chose the S&P 500, but I guess it really wouldn't have made much difference in the past year what investment option I chose. I probably wouldn't have gained any money, but the good thing is I didn't lose any money either.
Dan White is a certified financial planner and retirement specialist in Glen Hills, Pennsylvania.
What this type of contract does is it allows people to tie their interest rate to one or more of the major stock market indexes. All of these products have certain caps and limitations as to the upside potential that one can sustain throughout the life of the contract. They also offer fixed accounts inside the same contract in the event of a bear market. Okay, so one can switch back and forth between the fixed account and an index type of an account as market situations change.
The Izzos also decided to delay Kathy's retirement by a year in order to hang on to company benefits.
The delay helped me with our medical coverage, that I didn't want to switch our medical coverage midway through my treatment, and I could collect a benefit from work that I had earned, which was my sick leave.
The Izzos also chose to downsize their home, a move that can help cut down on spending, especially for empty nesters.
Eventually, I think we will save money in the long run because there's less upkeep. Plus, it's a new home, and it's Energy Star efficient, and our energy bills should be less than they were in the other house. And we don't have as much property upkeep and house upkeep.
For retirees who are confronted by a bear market, White recommends focusing on the near future.
A lot of people say to me today they hope the market comes back. You know, they'll say it always does, and I agree with them. The problem is it going to come back in time to benefit them?
At the end of the day, the Izzos say they know they've been safe investors.
I mean, I know we could have done a lot better had we put more money into investments. I'm sure we could have done better, but we're certainly comfortable, and we really can't complain.
Mark in Ohio, you're on the money line. Talk to us, Mark.
Yes, Carmen. I invested $175,000 over the last 5 years into equity index annuities. The current value today is $225,000, and my friends are telling me I should take the penalty on those, put it in the market, which would be about $200,000 after penalties. Do you think that's a good idea to do in today's market?
Well, Mark, are they advising you this because everything's so cheap? Is that the reasoning?
Are they brokers?
In the market?
No, well, listen.
Well, here's the thing. First of all, Ray, I want you to explain a little bit about the annuity product he has, because most folks with annuities, different types of annuities, would see a huge penalty that absolutely make no sense. He's saying his penalty is closer to 10%. I still don't think it makes sense.
It's a ludicrous penalty, first off. You shouldn't get out. Now, this is an equity indexed annuity. That means your principal is protected. You're going to get $225,000 out of this annuity. If you wait a few months, you don't pay the penalty. If you choose then to do a 1035 exchange or cash out and pay taxes, that's up to you. But to get out of an equity indexed annuity, which incidentally, the reason it's called an equity indexed annuity is because your interest that's credited on this policy is credited based on how well the index performs. So to get out of the market, to get into the market makes absolutely no sense.
I mean, Steve, think about it. I just don't feel like this penalty, taking it even now, it's going to grow over time, but it doesn't make sense. May. That's
no, of course. You should definitely hold on to it. But Carmen, you know, there's a bigger point here. The point is that, Mark, that you are looking at product picking. You're looking at this product here, this timing there. You really need to sit down and work out a plan to figure out what it is you're trying to accomplish over time. What is this money for?
Yeah.
Mark, did I hear you say that you began 5 years ago with about $175,000 in this product, and you have $225,000 now?
That is correct.
Boy, I wish in 5 years I had a product.
Pretty well,
I wish I had a product that had grown from 175 to 225 in the past 5 years.
But here's
That's
the thing,
not bad.
Mark. I mean, make that decision. You have a couple months to weigh your decision, but you really have to look at, like Steve said, like Ray said, what is this product you're in? Are you in the market? How are you in the market, Mark? I mean, I'd rather not see it in an annuity, but in the market, where are you going to be? Where's your exposure going to be? Don't try to time it. We saw what happened today. If you put all your money in on one day, you could lock in those losses.
This is a 5.15. I figured it out.
That's right.
A 5.15% rate of return for the past 5 years. You should be patting yourself on the back and actually thanking the person that sold you the equity indexed annuity. Stick with it at least until May, and then talk, as Steve said, to a financial advisor. It's a pretty good deal.
I know, and who knows what May will hold,
That's
Mark,
great.
so hang on tight.